A margin call is when we owe the broker money, and this can happen with short selling. A quick recap of short selling is we borrow stock and sell it, so we don't buy it, we don't pay for it, we borrow it, and it's sold to an investor, and it's based on the value of that stock for the day. So if it's worth £1, then the broker completes the sale transaction, and we now owe the broker the purchase of that stock. So we have a debt to the broker, and the debt is settled when we pay the current value of that stock, which can go up or down. So the idea with short selling is we think the price will go down to, say, 50p. So all we need to do is, from our brokerage account, give the 50p over to the brokerage, and they will complete the transaction, and we now make money. So that's how you make money with short selling, and that's good if the price goes down. But if the price goes up, that's when we can have a margin call issue. So given we have bought that one stock and we owe the purchase of one stock, well, in that scenario where we have 50p in our brokerage account, but the price has actually gone up to £5, then the difference there is 10 times. So we're leveraged 10 times. Now, the brokerage will make a margin call if the risk is too high. So if they're saying that a 10 times leverage is too high, then they're saying we're going to make a margin call, which is them saying we're going to ask you to pay for that stock. Now, we're saying, well, we still think it's going to go down in price, but the broker is looking at it saying, well, it's going up in price and up in price, and you've reached a limit now of 10 times. If it goes more, you won't be able to pay for it, so we're going to make you pay for it now before it gets really bad. And that's kind of what happened with GameStop. So the price was going up constantly, and the leveraged positions were exceeding the limits set. So at that point, the broker will usually, you have cash in your account and you have other stocks as well. And the broker at that point will decide to sell off your stock positions to pay and close that position. So when you complete that transaction, you're closing that position. So they are effectively managing their risk, and they're saying, okay, we need to close these positions before the risk gets even worse. And they could take your shares, say if you've got shares in Tesla and you're buying long positions, which means you're betting on the price going up and making money from that, they can actually sell those positions for you, and they're trying to obviously cover themselves to make that money back. So it can put you in a bad position because your debt is growing, and if you have stocks that are growing in value, they can actually take those and sell those, even though you might be holding them for 10 years, hoping that they'll make money in the long run. Well, they can take those and sell them in order to pay for closing these positions and mitigating that risk. So a margin call is when you're leveraged to a point that the broker says, okay, you now need to pay for this, and they're effectively demanding payment from you, and they will take any cash in your account, and they will take any stock holdings you have, and they will settle and close those positions. So that's a margin call.